Hello and welcome to the latest Insider interview. Our guest today is Marcus Phayre-Mudge, manager of the TR Property Investment Trust. Marcus, thank you for coming into the studio.
Thank you, Sam.
So can you please tell me a little bit about the investment trust? What are you investing in and how do you do it?
So TR Property Investment Trust is quite unique. It is the only investment trust specialising in real estate, primarily real estate equities, but it also owns a little bit of physical property. Our real estate equities are all over Europe, so we're fully pan-European in that respect, and our physical property is just in the UK, and it's just commercial property. But on a pan-European basis, we do invest through listed companies in both commercial and residential property.
And that physical property, so you're owning the buildings outright, what share of the portfolio is that at the moment? And is it typically about that much?
Yeah, it's currently 7%, which is a bit lower than normal. We generally have somewhere between 10 and 15%. That might seem like a relatively small percentage, but it's really useful for us because one, it helps us illustrate to companies that we're investing in, that we can make money out of physical property as well by improving and the way we're buying and selling. It also gives us direct market access. The broker community, the agents are prepared to talk to us because we're a potential buyer and seller of commercial property.
And in terms of sectors, do you invest across all property sectors and where are you most concentrated?
Well, we actually invest in across a very broad range. At the moment, our major exposure is to logistics and multi-let industrial. Offices, you might be surprised to hear, but primarily in continental Europe, we've seen a much greater return to office, particularly in smaller cities. So Madrid, Milan, Stockholm, Gothenburg, Berlin, Hamburg, those sort of markets, as opposed to London. And also focused on very high quality offices primarily. Otherwise, self-storage, student accommodation, healthcare, these are all markets that we're also invested in. Our retail exposure is actually focused again on the continent.
In terms of where a property portfolio fits into someone at home's investment portfolio, how would you describe it? Is it defensive? Is it about growth? Is it about income?
Yeah, it's a great question. It really is. It should form part of the sort of value income element of their portfolio. And at the end of the day, these businesses many of them are relatively mature. They've owned their assets for a long time. They do development. They do asset management, but a lot of them are there to drive a steady income from their portfolio. At the same time, of course, what's happened in the last 18 months, of course, the cost of money has gone up so much that's had a very severe impact on their cash flows. But we are focused very much on those businesses that have got the right type of balance sheet. So I would say that whilst we're at the value end of the spectrum within the real estate world, we're always looking for growth. We're always looking for those companies that are focused on markets that we think are going to see rental growth, i.e. tenant demand.
The shares are having a difficult run, and that is linked to rising interest rates since the end of 2021. What is the impact of interest rates on property and why are your shares falling?
All real estate is leveraged generally. Because in a normal cycle, the cost of money is less than the cost of the debt. So it makes sense to leverage, same way that you will have a mortgage on your house. The problem that has occurred in the last 18 months has been the very rapid change in the cost of money and all the reasons that we know about. So we have very much been focusing on those companies who are able to manage that cost of debt. Either they've got less in totality, or more importantly, they've been very smart about fixing their debt. No different to you or I taking a 5-year fixed mortgage 18 months ago. We'd all be very happy with that. At the same time, it's for us, it's really about that recurring income, and that's what's really crucial here.
And what are the really attractive sectors for income then? Where are you focusing at the moment?
Well, there's two elements to the income story. The first is the quality of that income. Who are your tenants? What's their robust financial position? And the second, of course, is are you in a market where rents are going to grow? So we're kind of focused on a bit of a barbell. In terms of the quality of income, you see that particularly in somewhere like healthcare, or student accommodation, or residential markets, regulated residential markets in Germany and Sweden, where these portfolios are basically fully let with a waiting list because the rents are sub-market. So that income is very secure. On the other hand, we're looking for markets where rents are growing, and we see that particularly still in logistics and in multi-let industrial. Self-storage has been a great market for us. And interestingly, even in prime offices, there is a shortage of really good quality office space, and we're seeing rents beginning to rise in that market as well.
There's been a big move in the share price linked to interest rates, as you said. Is it now oversold? Is it a great bargain opportunity to now buy shares in TR Property?
Yes, I mean, the trust, as you said, is standing on a 7% discount. But when you look underneath at the assets, that the REITs that we're invested in, they are trading on 30 to 35% discounts to their last published asset values. Now, essentially, that's the market telling you that it doesn't believe those asset values. It thinks those numbers are going to come down. Those asset values are going to fall further, which we also believe is correct. But we think we've very much reached an inflection point. And when you look over previous cycles, and I've been invested in real estate equities since 2000, so I've been through several of these, and I was a surveyor prior to that. We are definitely at some sort of inflection point because A, where the discounts are standing, but more importantly, the fact that if we're not at peak interest rate, we're incredibly close. So we see this as a really, really crucial 6 months where we could well see a very swift recovery in share prices, mainly because those discounts are going to close rapidly rather than necessarily the asset values start to rise. That's the following step. But we've had so much pain in the equity market. We're down 35%. Since the interest rates started to rise, that we now think we're into a recovery mode.
The portfolio yields about 5.5%. Is it an income trust? And where are you generating that yield from?
Yeah, well, TR originally stood for Touche Remnant because that was the founding fund management group. And then when we moved to Thames River, of course, we all said it stood for Thames River, just a bit tongue-in-cheek. Now we're part of the Columbia Threadneedle Group. We say it stands for total return, and real estate is very much a total return animal. But the income is a huge component of that when you look at it over a long period of time. So the board very much do want to maintain the dividend and dividend growth. At the same time, there will be short periods, hopefully only short periods, where the dividend the earnings are less than the dividend. And we are probably in one of those points in the cycle now, just because we've got a number of companies that have suspended dividends post the pandemic, and now they're restructuring their cost of debt. So we expect them to come back and start paying a dividend again in some of them not until probably 25. So, and if you look at the history of the trust, we have, as I said, on occasion paid an uncovered dividend, but always with an eye to an expectation of growth in the near term.
You can get about 5.5% from the investment grade corporate bond market at the moment, similar to your trust. So why should investors buy property over bonds if they're looking for income?
Yeah, it's the ultimate question. And the answer quite simply is growth. We consider real estate to be an income stream with a capital kicker. And that capital comes through either yield compression, where we're not seeing any of that at the moment, or it comes through rental growth. And so for me, it's the whole thing about the fixed income market is it is fixed. So essentially, I must make sure that I'm investing in companies where we are confident about growth. And what's really interesting, and it started long before the pandemic, and in fact was a consequence of the global financial crisis, is we saw far fewer debt providers prepared to take risk. So in the old days, you went to you're a developer, you went and borrowed money from the bank, you built the building, and you kept your fingers crossed that tenants would turn up. Post the GFC, the traditional banking community just stopped lending speculatively to real estate, and we saw a dramatic reduction in the amount of space provided in all markets, and essentially we're seeing that again. Now there are patches of development, but when you compare, say, Canary Wharf with the West End, we have vacancy in the West End of just sub 2%. So you read the horror stories about Canary Wharf, and that's quite right. There's a shortage of demand, there's been quite a lot of supply. But in the West End, if you want 10,000 square feet of brand new, grade A, BREEAM excellent rated space, I think you've got a choice of 2 buildings. So it's very much an opportunity now where the market is trading at deep discounts to its asset value, but actually fundamentals are really quite healthy. The problem, which we're now hopefully coming to the end of, is that our balance sheets for many of our companies were in the wrong place 18 months ago. They had too much floating rate debt. They've taken the pain, they've restructured, the shares are trading on big discounts, but actually operationally, I'm really quite optimistic.
Marcus, thank you very much for your time.
Thank you.
And that's all we've got time for today. You can check out more insider interviews on our YouTube channel, where you can like, comment, and subscribe. See you next time.